Welcome to the Daily Block, the top events happening in past day in crypto, and why they matter. Fast, snarky, and useful enough to ruin someone's P&L. Record bearish options flow, $1.15 billion poured into out-of-the-money Bitcoin puts. Implied vol turning negative options analytics from Greeks. Live show traders dumped a jaw-dropping $1.15 billion into OTM. Bitcoin puts in the last 24 hours, pushing OTM puts to roughly 28% of total options volume. Implied volatility is skewing negative. Basically, the market bought a ton of crash insurance, and now prices reflect it. The spike mirrors the panic around the October 11th washout, and looks like heavy hedging mixed with speculative short positioning. Why it matters? When puts flood the market, liquidity providers widen spreads, and option skew gets nasty, meaning downside protection is expensive, and market makers are primed to push prices into the parts of the book that hurt them least. Risk counterpoint. If those put buyers are hedging long exposure, delta flows could actually support price if buyers are covered. But if they're straight short bets, liquidation cascades are on the table. Quick pivot. Insider whale opens $163 million BTC short after banking $192 million. Another 9-figure leveraged bet on-chain sleuths pegged a large wallet that recently pocketed $192 million from a short and then re-entered with a $163 million short, using 10 times leverage on Hyperliquid. The position showed unrealized profit almost immediately, which smells like either filthy timing or a trader with macro headlines on speed dial. This reignites the old insider whale narrative. One coordinated, mega-levered wallet can tilt the market. Why it matters. A single whale can trigger localized spikes in funding and cause cascade liquidations if price moves against them. So watch where that wallet's margins and collateral live. Risk counterpoint. Big players sometimes buy liquidity rather than drain it. If they hedge carefully, their flows can be a source of temporary stability rather than pure chaos. Moving on. Liquidation map lights up. Dense long leverage at about 111,000 to 113,000 coin glass heat maps show a thick mattress of long leverage clustered between roughly 111,000 and 113,000, many positions at 25 to 100 times leverage. That means if price cracks that band, forced selling could exacerbate the move badly. Conversely, shorts stacked above 115 to 120,000 make for dangerous short squeeze math. Why it matters. These leverage pockets act like magnets for price. They create self-feeding moves where one side's pain funds the other side's fireworks. So position size and stop placement matter more than ego. Risk or counterpoint. If liquidity providers step in or spot buyers defend that band, the magnet can flip and trap the shorts instead. Heads up. $540 million wiped in recent derivatives liquidations. Altcoins dumped hard. Roughly $540 million of liquidations hit exchanges over the last day as sellers flushed positions. Ethereum saw about $5.6 million liquidated, and smaller alts like Aster, LDO, and ZEC took double-digit exits. The Financial Stability Board warnings and geopolitical tariff chatter were called out as catalysts, but the mechanical deleveraging did most of the damage. Why it matters. After a big liquidation event, market depth thins and volatility stays elevated. Day traders face whipsaw risk, and the next squeeze can come faster than your stop. Risk or counterpoint. Liquidation episodes also create chopping opportunities and mean reversion plays for nimble traders if they can manage execution and slippage. Switching gears. Kraken buys small exchange for $100 million. U.S. regulated derivatives play Kraken completed a $100 million pickup of small exchange, a CFTC-regulated designated contract market, which gives Kraken a straight regulatory path to offer onshore futures and options. Kraken says this will let it unite spot, futures and margin inside a regulated U.S. shell. Welcome to the good side of compliance. Why it matters. More regulated U.S. derivatives capacity means easier institutional entry and potential liquidity, migration from offshore venues, which could change funding and basis dynamics over time. Risk counterpoint. Regulatory integration is messy and slow. Having the license doesn't instantly deliver flow. Execution and product design will determine whether this matters. Quick handoff. BlackRock retools a money market product to serve stablecoin issuers with BSTBL tweaks. BlackRock relaunched a treasury-based liquidity product tuned for stablecoin issuers, with longer trade cutoffs and features aimed at reserve managers who need regulated liquid parking for client fiat. The pitch is straightforward. Give issuers predictable, institutionally safe rails for reserve yield and liquidity. Why it matters. If major stablecoin issuers shift reserve allocations into institutional money funds, they could divert huge fiat flows off-chain and reshape stablecoin supply dynamics and on-chain liquidity. Risk counterpoint. Stablecoin issuers also care about on-chain immediacy and regulatory optics. Not all of them will move large buckets into institutional funds overnight. Quick switch. Binance re-enters South Korea via Gopak's takeover after regulatory approval. Reports say Binance regained a formal foothold in South Korea by taking control of Gopak's after getting the necessary regulatory sign-offs. That puts a major liquidity provider back into one of Asia's most retail-active markets. Think high volume, tight spreads, and rapid reaction to local news. Why it matters. Regional liquidity shifts are global. Renewed Binance flow in Korea can change spot and derivatives order flow, tighten arbitrage windows, and become a fulcrum for big moves. Risk counterpoint. Local regulation can limit activity or introduce constraints that mute any immediate impact. Actual flow recovery may take time as users migrate back. Last major item. CME reports $901 billion in crypto derivatives. Volume in Q3. Institutional demand is diversified. CME. Group says crypto derivatives traded $901 billion in the third quarter. And product expansion now includes options on Solana and XRP futures as institutions spread beyond BTC and ETH. Open interest growth and new institutional participants point to stronger hedging and active trading on regulated venues. Why it matters. Heavy professional activity on CME means institutional flows are a structural driver of volatility and liquidity. Track CME open interest, product launches, and funding as bellwethers for where big money is tilting. Risk counterpoint. Institutional flows can be steady or fickle depending on macro shocks and capital constraints. High CME volume doesn't immunize markets from sudden retail surges. Micro brief for day traders. Quick actionables. Be size conservative. Clustered long leverage near 111,000 is fragile. Smaller sizes and wider stops help. Options skew and heavy put. Buying mean downside insurance is expensive. If you're selling premium, size for the risk of faster implied volatility. Crush. Watch flagged whale wallet addresses, live liquidation maps, and funding rates on CoinGlass, Deribit, and Greeks.live. The order flow will tell you where the pain points are. Track regional exchange reopenings like Binance Korea and Kraken's small exchange play for shifting flow between US and APAC desks. That's the tape for today. Hit subscribe if you want daily snark with a side of useful on-chain receipts. Stay alive out there. That's Today in Crypto, where the gains are imaginary and the pain is real.